There is a number that nobody is telling you. Not your bank, not your employer, not the financial influencers selling courses online. A number that, once you hear it, once you actually let it land, is going to make you look at every dollar you have ever earned in a completely different way. And the most alarming part is not the number itself. The most alarming part is that you have already had access to this money. You have already earned it. It has already passed through your hands. And it is already gone. Every single year, the average person loses $10,000, not to bad investments, not to medical emergencies, not to anything they consciously decided, but to the slow, invisible, automatic leak of modern life. That is the number. $10,000. Vanished. And the reason nobody talks about it is because the people profiting from that leak have spent billions of dollars making sure you never notice it is happening. But you are going to notice it today. And once you do, you cannot unsee it. Here is the number that should stop you cold. The average American wastes, not spends, wastes roughly $10,000 a year on things they didn't consciously choose and won't remember by December. That's lifestyle drift. That's the gym membership that charges you every month for a gym you stop going to in February. That's the 3 streaming platforms running simultaneously on a Tuesday night when you're asleep. That's the daily purchases, the impulse decisions, the automatic charges that pile up so quietly you never feel them leave. $10,000. Gone. Every single year. Now break that down. $10,000 over 365 days is $27.40 per day. That's the number. $27.40. That's what's leaking out of your financial life, invisibly, every single day. And on its own, it doesn't feel like anything. It feels like rounding error. It feels like the cost of being alive in a modern economy. But here's what $27.40 a day actually is, when you stop spending it and start investing it instead. At a historical average market return of 10% annually, $27.40 per day, invested consistently, left alone, allowed to compound, grows into $4.4 million over 40 years. $4.4 million. Not from a windfall. Not from a lucky stock pick. Not from a side hustle that went viral. From the money that is currently disappearing from your life without your permission. That is what is at stake in this conversation. That is what the next 20 minutes are actually about. The reason most people never build wealth has nothing to do with income and everything to do with a concept called lifestyle inflation. Lifestyle inflation is what happens when your spending automatically expands to match and then slightly exceed every raise, every bonus, every increase in income you ever receive. It's not something you decide to do. It just happens. You make more, so you upgrade the car. You get the bonus, so you take the nicer vacation. The apartment gets a little bigger. The meals get a little more expensive. And before you know it, you are making twice what you made 5 years ago and saving exactly the same amount. Nothing. This is not a character flaw. This is the default operating mode of the modern economy, and it has been very deliberately engineered to work exactly this way. The phone in your pocket is not a communication device with some payment features built in. The phone in your pocket is one of the most sophisticated wealth extraction machines ever designed by human beings. Think about the engineering that went into it. The world's most talented behavioral psychologists, the most advanced data scientists on Earth, teams of designers who have spent entire careers studying what makes the human brain feel urgency, feel reward, feel the compulsive need to act right now before the opportunity disappears. All of that genius, all of that talent, all of that funding pointed at exactly one goal: getting your money out of your account and into someone else's as frictionlessly and as automatically as possible. And the primary weapon they use is not advertising anymore. The primary weapon is the subscription. Subscriptions are brilliant as a business model because they exploit a very specific quirk of human psychology. We feel loss much more sharply than we feel the absence of gain. Signing up for something feels like getting something. Canceling feels like losing something, even if we never use the service. So we sign up easily and cancel reluctantly. And in the space between those two decisions, we hemorrhage money every single month without making a single conscious choice to do so. The average person today carries between 10 and 12 active subscriptions. Many people, when they actually audit their statements, find services they completely forgot existed. A cloud storage plan from 3 phones ago, a premium tier for an app they deleted, a box subscription that just keeps shipping and charging and shipping and charging. Add it all together, and you are looking at anywhere from $150 to $400 a month. Gone. Automatically. On autopilot. This is what it means when people say the economy is rigged. It is not rigged by some shadowy conspiracy. It is rigged by automation, by an invisible financial infrastructure designed to make spending effortless and saving difficult, to make signing up frictionless and canceling annoying, to make the path of least resistance the path that makes everyone else rich. But here is the critical insight, the one that changes everything. Automation itself is not the enemy. The direction of the automation is the enemy. And you have the power to reverse that direction completely. The formula is called the 1 hour a day rule, and it is the closest thing to a guaranteed path to wealth that exists for ordinary working people who are not going to inherit money, win the lottery, or build the next billion-dollar startup. Here is how it works. When you go to work, a standard 8-hour day, the first hour or 2 of your labor does not belong to you. It belongs to the government. Federal taxes, state taxes, local taxes. Before a single dollar hits your bank account, the government has already taken its cut. The next portion of your workday often goes to the bank. Your mortgage or rent, your car payment, your minimum credit card payments, your student loans. The debt servicing that consumes your income before you even have a chance to make a decision about it. By the time you're actually earning money that is going to stay in your life, you might be 3 or 4 hours into an 8-hour day. The 1 hour a day formula flips this entire sequence. Instead of paying the government first, the bank second, and hoping something is left for you, you pay yourself first. You take the equivalent of 1 hour of your daily labor, 12.5% of your gross income, and you route it directly into a retirement or investment account before it ever hits your checking account, before the government calculates your taxable income, before the bank gets its portion, before the subscription charges hit, before you can see it, touch it, or spend it. The money is gone, to you, to your future, before the system has a chance to take it. Now, 12.5% sounds like an impossible number if you've never saved before. So here is how you actually start. You start with 1%, not 12.5. 1. If your household earns $50,000 a year, 1% is $500. That is $42 a month. $1.40 per day. You will not feel that. Your lifestyle will not change. You will not notice it is gone. And the following month, you increase it by 1 more percent. The month after that, 1 more percent again. At that rate, 1% added per month. By the end of the year, you are at 13%, right in the target range. And the entire journey from 1% to 13 cost you less than $1 more per day in each monthly step. Your brain never gets the chance to register the change as a loss. The lifestyle inflation machine never activates. You simply, quietly, systematically become someone who saves. And here is where the government, the same government that takes its cut before you see $1, actually starts working for you instead of against you. When you contribute to a pre-tax retirement account like a 401k or a traditional IRA, that money is invested before your taxable income is calculated. If you are in the 22% federal tax bracket, every dollar you put into that account effectively costs you 78 cents because the government was going to take 22 cents of it anyway. You are not losing that money. You are redirecting it from the IRS into your own future. Over 40 years, that tax-advantaged compounding can add hundreds of thousands of dollars to your retirement that you would have otherwise simply handed over in taxes. The tax code was written by people who understand compound interest very well. It has a massive structural benefit built into it for people who save early and save pre-tax. Most people never take advantage of it. You are going to be different. Where does the money go once you've saved it? This is the question that paralyzes people, and it should not, because the answer is genuinely simple. You do not need to pick stocks. You do not need to watch financial news. You do not need to understand options trading or cryptocurrency or any of the complex financial instruments that are designed, frankly, to make money for brokers and advisors rather than for you. For the vast majority of people in the vast majority of situations, the answer is index funds. An index fund is a basket of investments that tracks the entire market. A fund like VTI, the Vanguard Total Stock Market ETF, holds a piece of literally every publicly traded company in America. The good ones and the bad ones. The ones that will collapse next year and the ones that will be worth 10 times as much. You own all of it, which means you capture the overall upward movement of the market without having to correctly guess which individual companies will win. Historically, over long periods, 30 years, 40 years, the market goes up. It does not go up every year. It does not go up in a straight line. But the long-term trajectory is up, and index funds are the most effective and lowest cost way for a regular person to ride that trajectory. If you want something even more hands-off, target date funds go one step further. You choose a fund based on the year you plan to retire, a 2055 fund if you're retiring around then, and the fund automatically adjusts its own risk profile as you age. When you're young, it holds more stocks. As you get older, it gradually shifts towards safer bonds. You do not have to think about it. You do not have to rebalance anything. The fund manages itself, and your only job is to keep contributing. This is not a sophisticated strategy. This is what financial advisors who actually care about their clients recommend to almost everyone. The complexity of the investing industry exists to generate fees, not returns. There is a psychological phenomenon in behavioral finance called the ostrich effect. It describes the very human tendency to avoid looking at information that might be frightening or painful, to bury your head, the way the legend says ostriches do, and pretend the problem is not there. Research shows that people check their investment accounts significantly less often during market downturns. When the numbers are red, when the portfolio has dropped, when the news is full of recession warnings, people stop looking. And the tragedy is that looking away at exactly the wrong moment is what turns a temporary decline into a permanent loss. Because when people finally look, when the panic gets too loud to ignore, they sell. They sell at the bottom. They lock in their losses. And they miss the recovery that has, historically, always come. Fidelity Investments did a study to find out which of their customers had the best long-term investment returns. The answer was both funny and profound. The accounts that outperformed every other category, beating active traders, beating people who checked their portfolios regularly, beating people who tried to time the market, were accounts belonging to people who had either forgot they had the account at all or were dead. Deceased investors outperformed the living. Not because dead people have better financial instincts. Because dead people cannot panic. They cannot log in at 2 in the morning during a market crash and move everything to cash. They cannot watch the news and convince themselves that this time the recovery is not coming. They are protected by circumstance from the single most destructive thing most investors do, reacting emotionally to short-term volatility. The secret of automatic millionaires, people who build genuine wealth on ordinary incomes, is not discipline in the traditional sense. It is not white-knuckling it through temptation every month. It is engineering a system that removes temptation from the equation entirely. The money moves to investments before it hits your checking account, so there is nothing to resist spending. The contributions happen automatically on payday, so there is no decision to make and no willpower required. The portfolio runs on autopilot, so there is no daily number to panic about. You build the system once, and then you get out of your own way and let it work. The goal is not to be the most disciplined person in the room. The goal is to build a system that does not require discipline to maintain. Before the action steps, there's a warning that is worth every second it takes to hear, because the mistake it describes costs the average person $300,000, and it happens silently to millions of people every single time the job market moves. When you leave a job, your retirement account stays with your former employer's plan until you roll it over to your new employer or to an individual account. Rolling it over is the right move. The disaster happens in the details of how the rollover is set up. Most new employers auto-enroll new hires at a default contribution rate. That default is typically 3%. 3% does not feel like anything. It does not hurt. It does not register. But if you were contributing 14% at your previous job, a healthy, sustainable rate for someone who has been building wealth seriously, and you roll over into a new plan at 3% without catching and correcting the default, You have just reduced your retirement contributions by nearly 80%. And because it all happens automatically, because you never see it as a decision you might not notice for months, for years. A Vanguard analysis of this pattern found that people who defaulted to lower contribution rates after switching jobs lost an average of $300,000 in retirement wealth over the course of their careers, not from bad investments, not from market losses, but from not checking one setting on one form. Every time you change jobs, before anything else, you find your new retirement account and you set your contribution rate to match or exceed what you were saving before. You do not let a corporate default be your financial decision. Now here is a different way to think about what you are building, one that is more honest and more motivating than a number in an account. Buckminster Fuller, the architect and systems theorist, defined wealth not as a dollar amount, but as time. Specifically, he defined wealth as the number of days forward you could survive if you stopped working today. Under this definition, wealth is not a balance. Wealth is distance, the distance between you and financial catastrophe. It is the freedom to say no to a job that is destroying your health, no to a situation that is making you miserable, no to anything that requires you to choose between your dignity and your rent. A person with $1 million who spends $10,000 a month is 100 days from poverty. A person with $100,000 who needs only $500 a month to live is nearly 6 years from needing to work. Which person is wealthier depends entirely on what wealth actually means. When you start measuring wealth in days instead of dollars, every financial decision looks different. You stop asking whether you can afford something and you start asking what it costs you in time, in days of freedom, in distance from the life you are building. And passive income, money that arrives while you sleep, from investments compounding, from assets you have built. Passive income is what converts that equation permanently. When your passive income exceeds your monthly expenses, you have crossed the line into financial independence. Not retirement necessarily, not the end of work, but the point where work becomes a choice rather than a requirement. That is the target. That is what every automated contribution, every skipped subscription, every reinvested dividend is building toward. So here is where this ends, not with information, but with a decision. The world offers an easy story to tell yourself about why building wealth is impossible. The economy is unfair. The system is stacked. The boss doesn't pay enough. The government takes too much. Every one of those things may be true. The system is genuinely tilted in ways that are unjust, and the frustration people feel about that is completely legitimate. But the people who build real wealth anyway are not the ones who wait for the system to become fair. They are the ones who take complete and absolute responsibility for the one financial account they actually control, their own, and they start building regardless of conditions. There's an old story about two people who both carry buckets of water from a river to a village every single day. One of them carries more buckets, works harder, gets more efficient, earns a little more each day, and comes home exhausted. The other one, instead of carrying more buckets, spends her evenings building a pipeline. She earns less in the short term. She is tired from the building on top of the carrying. But when the pipeline is finished, water flows to the village while she sleeps. It flows when she is sick. It flows when she takes a month off. It flows without her indefinitely for the rest of her life. Most people are bucket carriers. The retirement accounts, the index funds, the automated investments, the compound interest machines, those are the pipeline. And you do not start building the pipeline when conditions are perfect. You start building it with $1, 1%, one automated transfer that happens before you can spend the money. The easiest way to get rich quick is to get rich slow. The math is already on your side. Time is already on your side. The pipeline does not care about your income level or your past mistakes or how long you waited to start. It only cares that you start. Choose yourself. Automate 1% today. And let the system you build do what no amount of willpower ever could.